Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for a whole $3, and hater of trash investment advice, clowns, charlatans, and losers on YouTube, and most of all, garbage stocks like Uber. Now, I get a lot of hate on my channel, but I'm actually the good guy because I'm pointing out to you that all these speculative stocks that you think are going to take you into the moon or Mars or whatever are actually going to have you down at the truck stop in retirement. And if you don't know what that means, go check out my buddy Jay Nagy and he'll explain it to you. Now today, got something in my eye. We're going to talk about Uber, which is Uber trash. This is a garbage stock. Now, if you're placing all your hopes and dreams into this unprofitable, cash-bleeding, massively diluting company, you're a sad person. Now, we all know what Uber does, okay? I've taken Uber. I usually take Lyft, though, because they're a little bit cheaper, usually. But Uber is basically just a ride-hailing app. You need to go somewhere, you hire some driver, independent contractor, and they take you somewhere, which is a cool concept, and it's been hurting a lot of taxi drivers. Not that I care about taxi drivers. But at the end of the day, all that matters to me is the stunk. Is the stock making money? Is it profitable? Is it generating positive and growing operating cash flows? Is it not diluting the current shareholders? This garbage, this piece of crap stock meets none of those requirements. This stock is garbage. Let's go check it out. Now, I do this crazy thing on my channel where I read the 10K, which is the company's annual report. And I read the risk factors and I look at the financial statements, things that Wall Street Bets obviously doesn't do. I actually look at the numbers and the fundamentals to help me determine if I want to invest in a company. So let's go look at Uber, which is Uber trash, Uber poop, Uber garbage. And I'm going to show you why this company is going to have you selling something down at the truck stop in retirement if you're YOLOing into it. So let's go read the risk factors because there's a lot of risks in this poopy company. And this 10K pisses me off because they don't have links. There's no links I can click to just jump to the page I want to go to. So let's read the risk factors. You want to read this, ladies and gentlemen, to learn about what kind of risks and competition the company is facing. So risk factors, COVID pandemic, blah, 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 blah. Our business could be adversely affected if drivers are classified as employees, workers, or quasi-employees instead of independent contractors. Now, the reason this is bad is that this will increase the expenses that the company has to pay for employees. Because employees got to pay all sorts of taxes and benefits, and it basically makes your business costs go up if you have to actually pay people and classify them as employees. So this is a big risk that this company is facing. And it's not even profitable now. And imagine if, on top of that, there's a new law that comes out that says all Uber drivers now have to be classified as employees. That's really going to hurt their profitability, which they're not profitable. Next risk. The mobility, delivery, and logistics industries are highly competitive. I know, I usually take Lyft. With well-established and low-cost alternatives that have been available for decades. Low barriers to entry, low switching cost, and well-capitalized competitors. Wow. So, number one, there's a risk that the employees may be classified as, the contractors may be classified as employees. And number two, it looks like Uber doesn't have much of a moat. Now, does it, ladies and gentlemen? Wow. We have incurred significant losses since our inception, including in the United States and other labor markets. We expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability. Now, I don't know if you knew this, ladies and gentlemen, but when you make an investment, you want to see profits. Otherwise, you're just giving a company money so they can burn it away on whatever stupid crap they're doing, all right? So right off the bat, just reading through these risk factors, I would immediately discount investing in this company. But I know all you YOLO diamond hand fools, they don't care. You don't care about money. You don't care about profits. You just want to YOLO into a stock because you saw an article or you saw a YouTube video. But I hate to burst your bubble, bucko. Now, let's go look at the financial statements. I'm going to have to scroll down because there's no freaking links. Pisses me off. Oh, God. This is so hard to put links here, ladies and gentlemen. All right, so the financial statements, you have the income statement, you have the balance sheet, you have the statement of cash flows. You should look at those, okay? You need to look at the numbers. Let's see the auditor's report. I wonder if, whatever. I'm not going to invest in this company, so I don't care about the auditor's report. All right, so here's the balance sheet. Obviously, you just want to look at, current assets over current liabilities. That's current ratio. That tells you the company can pay short-term debts, which they can, because they have $13,925, I guess that's billions, of current assets, and $5.6 billion of current liabilities. So they're not going to go bankrupt anytime soon. But the reason that's the case is because they're probably issuing tons of debt and tons of new shares, which dilute the current shareholders. Now let's go look at the equity. So they have common stock. Let's see how the common stock has changed. So it looks like they had 1.7 million shares outstanding in 2019, and then they have 1.8 million shares outstanding in 2020. It looks to me like they're issuing more shares of stock. Now, the more shares of stock there are, the less profits each individual share of stock is going to receive. It's very important, okay? I know you don't think that matters, but it does. Now, the next thing we're going to look at is accumulated deficit. Now, your accumulated deficit shows you your losses stacked up on each other. So this company, if you see the accumulated deficit grow on their balance sheet, that means they had a loss year over year. So their accumulated deficit was $16 billion. So far, this company, on an accrual basis of accounting, has lost $16 billion. YOLO! The next year, the accumulated deficit has increased to $23 billion. So they lost, $7 billion last year? Jesus, what is wrong with you people? You make me sick, all right? Let me go look at the income statement. All right, they have a little bit of revenue growth from 2018 to 2019. Revenue drop because of the pandemic, whatever. Loss from operations. Even despite the pandemic, before the pandemic, they were having losses from operations. $3 billion in 2018. $8.5 billion in 2019. $4 billion, almost $5 billion in 2020. This company is a pile of stinking poo-poo. Jesus. All right, next thing, weighted average shares used to compute net income or loss. This shows you how many shares they're issuing, all right? So in 2018, they had 443,000 shares. The next year, they almost tripled their amount of shares in 2019 to 1.2 million. And then, of course, they issued even more shares to 1.7 billion. Dilution, dilution, dilution. Unprofitable, unprofitable, unprofitable. Do you see what I'm talking about, ladies and gentlemen? If you're investing in this stock, you're just giving them money so they can burn it on garbage. And there's so many risks, and there's such a low moat for this company that I'm not really confident about its future prospects. Now, the last thing we're going to look at, statement of cash flows. I know, are you bored? I know, we're looking at numbers. It's boring. Oh my God. You should just be YOLOing them. You should just be talking how amazing the stock's going to be and how it's going to 10x because you're a YouTuber. All right, net cash used in operating activities. So in 2018, they burned $1.5 billion. Shocking. In 2019, they burned $4.3 billion, and in 2020, they burned $2.7 billion. Now, cash flows from financing activities. Issuance of long-term loans. Okay, so they're issuing debt. Let's see. Issuance of common stock. Yep. What is that? $500 million. Preferred stock, $1 billion. Common stock, more, $7.9 billion. I mean, holy crap. This company is a stinking pile of trash. All you have to do is look at a couple things, and you can immediately discount whether you want to invest in a company or not. Now, the reason I always harp on these companies is because there's so many clowns on YouTube, and they're growth investors. And the reason they're growth investors is because they don't have to really justify anything. They can just make wild assumptions, and you can't really prove them wrong because those assumptions are based on future events that nobody can predict, okay? That's why I hate the vast majority of YouTubers, because even though they're probably wrong about everything, by the time they're proven wrong, they've already made enough money hyping and shilling certain stocks that they can just disappear, and it doesn't matter if you lost all your money by investing in the stocks they're recommending because they were able to grift enough. They were able to, generate ad revenue and sell Discords and garbage courses that by the time they're proven wrong, which is years down the road, they've already made their money, and they've screwed you. Now that's it, ladies and gentlemen. Like the video, subscribe to my channel, don't invest in Uber, because it's Uber trash, and y'all have a wonderful, delicious, superstitious, cacalicious day.